your return on your time. This is more of a message across asset classes, like when you're buying B versus C or A versus B or whatever. It's going to take you less time to asset manage, to property manage, and to operate the building that's more well located. And again, it ties back to the first 2 points. When you have less turnover, when you have a lower vacancy rate, again, that carries down into less work from a management standpoint on the leasing side, less work from a management standpoint on the turnover and the reno side. All of those things flow down to this demands less time. Even if you have a PM involved, you still are going to be involved from an asset management standpoint, sharing your opinion on what the rent should be when you list it, sharing your opinion on the scope of work when you have a vacant unit, having to deal with what happens when there's an eviction, all of that stuff, right? Again, everything gets easier when it's better located. Everything, it's a rising tide lifts all boats scenario. And then you end up making more dollars per unit of your time, which I think is a really valuable consideration that people overlook. So yes, your projected returns. Maybe you're underwriting to a 17% IRR for your C-class deal, 16% for this one that's a little bit more well located. You want to pursue the higher return because again, you're in a position in your business where you're trying to stretch your dollars. But then you realize that there's a downstream drag on your business that doing the more demanding deals has, to where you would rather invest less time into operating the deal and make less money because you are earning a higher dollar per hour on per unit of your time. It's a really important consideration that I think people forget.